So let's take a look at the fixed income markets. It's been a decent year so far. We're off the highs of January. We had that euphoric spike in, got all dark all of a sudden, spike in returns across many asset classes in January. But broadly, you see that high quality parts of the market, like treasuries and agency mortgages, are up about 3.5%. In the beige towards the kind of right hand side, you can see that that's the corporate credit markets. This is through April 30th. Both IG and high yield up north of 4%. Both have given some back in the last through mid-May here. And bank loans also up 3-4%. So everything was kind of up. The securitized markets, a little bit shorter duration, so up a little bit less. Also, spreads are still wide relative to corporates, so we have some room to catch up. The only thing that's negative here on this screen is that CMBS below the BBB portion of CMBS, given some of the headline risk around the commercial mortgage market. And if I had an index for kind of more esoteric parts of the ABS market, those are also lagging the broader markets. But, while we're off the highs in yield, there's still a lot of yield out there. On the left-hand side, you can see going into more traditional parts of fixed income, again, treasuries, agency mortgages, corporate bonds. You can mix those together in an index-type portfolio, get a yield something like, mid-4s with a mix of treasuries, agency mortgages, and IG. And then if you add some of the plus sectors and the non-traditional parts of the market, some of the securitized sectors and higher yielding parts of the corporate market, maybe a little EM, now you're getting bond funds out there on the intermediate category that have yields around 5.5 to 6%. So competitive with long run equity returns in some instances, especially at the risk spectrum, that should provide, we think, diversity to equities. Unlike last year, which was a year where correlations went to 1. Securitized yields look especially high relative to history because a lot of these assets sit on the shorter end of the curve, and the curve is inverted. Here you can see 4 of the benchmark sectors within the securitized markets. On the top left is the non-agency mortgage market. This is an example of a non-qualified mortgage bond looking across the capital structure, AAA down to BB. CMBS conduit on the top right-hand side, AAA down to BB. ABS subprime auto deal on the bottom left, and a traditional kind of CLO, floating rate CLO structure on the bottom right. We're off the highs in yields. The yield highs were probably around October of last year when we just had a ton of supply, kind of peak Fed, fears about hiking rates, and we the 10-year peaked around October. We're off the highs, but you can still find that there's investment grade pockets of the market where you can find close to double-digit type yields, 8-9% yield in RMBS and CLOs, 11% yield for BBB CMBS. For a reason, there's some risk associated with office, so there's a reason it's wider there. But again, you can find some pretty attractive yields out there. We're off the highs. AAA non-agency, as an example, got all the way up to 7% plus yield. Spread of 250. The 2-year got north of 4% to 5% for a moment pre-Silicon Valley Bank. The spreads have come in a little bit, and short-term rates and long-term rates have fallen, but we're still talking about pretty attractive all-in yields relative to history. You can see a year back, everything was in kind of the 2s, and if you went all the way to the bottom of the capital structure, you were lucky to get double digits. Here you can get mid-teens in things like BB CLOs. We think rates have topped. On the 10-year was last year. We got up to about 430-ish, and we've been in this weird tight trading range over the last couple of months on the 10-year, and equities for that matter too. It feels like the S&P 500 has been 4,100 plus or minus 1.5% for like the last 30 days. The 2-year peaked right before Silicon Valley Bank, we think. That's come down a lot too. So we think both these rates have peaked. There could be maybe one more surprise to the upside. We get a surprise on inflation up, and maybe these rates back up a little bit. But we were kind of talking to everyone about the buy zone being somewhere between 3.75 and 4% on the 10-year. I think after Silicon Valley Bank and the kind of the pullback in lending from regional banks, I don't know if the market has the ability for the 10-year to get back up towards that 4%. So I would say if you haven't added duration to your portfolios and you're looking to bring that buy zone down a little bit, We're backing up today here. We saw about 355 on the 10-year. If we get kind of a 360 handle, maybe 370, maybe not a bad time. I'm not quite sure we get all the way back up to 4%. So what I've been telling investors is don't get too cute. You're not playing for 20 basis points here. You're playing for protection in your portfolio for the 10-year to go from 350 to 250, right? You're playing for kind of that long run fall in rates as the economy potentially slows. And if it doesn't, you have enough yield and fixed income to protect you for rates rising. You can still have positive returns given the high yields you can get in many parts of the market. Well, the bond market basically thinks we're cutting rates pretty surprisingly. I mean, thinks by September that we're going to have one cut and we're going to be down almost 100 basis points lower by the beginning of next year, which is kind of why some parts of the stock market are doing well, like mega cap tech, which is kind of, almost like a rate play at times. When rates go down, big tech likes to go up. It's kind of has duration, they say, in the equity markets. But, one would think that if this plays out, that's pretty negative for the economy. So broadly speaking, you probably see growth slowing in the economy, turning over, earnings rolling over, and then equities reprice. So I'm not sure we see this happen with rates coming down this quickly. The economy is kind of a mixed bag. We'll look at some data shortly, but at some point I do think rates come down. So we still like rates for the long run. It's just that short-term rates may not fall as aggressively as the market's implying here on the left-hand side. A couple things the Fed has going for it, though, is that break-evens are relatively anchored. There was a moment in time in early 2023, the blue line, the 2-year break-even, was shot up pretty dramatically. And that was not a good thing. That was pre-SVB. And if you look back to the last time that happened, that was in kind of right before the hikes in early 2022, which led to a big shakeup in markets, increased volatility, stocks down, spreads wider. And that's come back down. It's come back down pretty dramatically. In fact, you can see that it's collapsed from like 340-ish down to sub 2%. This is one of the reasons I think that you've seen credit spreads kind of hold in here, is the anchoring of those short-term and intermediate term, and I guess long-term inflation expectations. So the market, at least priced by tips, is saying that inflation has calmed down. So as we look at kind of the broader fixed income markets, this is my What's Cheap report that we look every month now on Channel 11. It's pretty helpful. We release this once a month. And this shows the different pockets of fixed income, looking at the cheapness relative to their own history, going back 10 years. So right now, the stuff at the very top, and I'll just point out to the top left, that really stand out right now, in both 98th, 99th percentile, I guess 97th for CMBS. It was 98th at the end of the month in April, meaning that, for example, agency mortgage spreads, only 1% of the trading days over the last 10 years has the spread been wider. And on May 15th, it was 174. The high in October was about 179. So basically retested the October highs and wides on spreads there. IG is definitely cheaper than it was, I would say, 30 to 60 days ago. IG got all the way down to sub 50th percentile, maybe mid to high 40s. And it's backed up here, so it's looking a little bit cheaper, high yield on the richer end relative to its own history. But that means it's done well. And so whenever I show this to people, some say, well, what are you trying to hide from me? Why'd you only go back 10 years? Well, 10 years is a nice round number, which is why we go back 10 years. But also some of these indices didn't exist 10 years ago. So we went back 20. We said, okay, we'll do what about the GFC slide? Here it is. And this takes the indices that we have data for going back now 20 years. And we can see on this metric, this will make credit look more expensive since it got really wide during the GFC. And you can see that mortgages still look pretty cheap on this basis, 81st percentile. So you look at this and you'll tell me, well, Ken, what about bank loans? Bank loans also look pretty cheap. They do, but they might be cheap for a reason. Bank loan funding costs have gone up a lot with the short-term rates higher. So a company that was funding at LIBOR plus 500, 2 years ago with LIBOR at 0 is now funding at 10%, not 5%, with effectively doubling their cost of debt. And so that's just something to think about. Doesn't mean there's not great opportunities out there. So we will, we can still pick and choose our battles. We don't buy bank loans in income, but we have that exposure to CLOs, a mix of BBB and BB CLOs that have pretty high yields now with the SOFR rates up. Here's just a graphical observation of what's called the current coupon MBS spread. This is the bond that's trading closest to par, backed by mortgage loans that are created today, which are around a 6.5% mortgage. You strip out servicing fee, you got to pay Fannie, Freddie, and Ginnie Mae to wrap the deal and make it government guaranteed. So you're left with about a 5.5% coupon bond that's trading around par. And you can see that spread got all the way to 179 October of last year. We rallied into pre-SVB down into the 120s. And now we've backed up to kind of 174 with a lot of supply coming from the FDIC sales of the Silicon Valley Bank assets through BlackRock, which so far have been digested pretty well. There's been pretty good demand from the market. There's also, a lot of supply is down. We're probably going to be down 50% in origination volumes in the MBS market. So while there's a supply headwind of the SVB assets, there's, a potential tailwind of lack of origination. So if there's any net marginal demand because spreads are wider from money managers, insurance companies, other buyers, unfortunately the banks aren't buying because the banks are all worried about deposits leaving. But as other money steps in, seeing relative value, that could contain spreads here. So I don't see that much more downside. We got to the 250, 300 area on spread during the GFC. You can see that on this slide. That was from a brief moment in time. That's when we thought Fannie and Freddie were going under. So that's kind of worst case scenario for agency mortgages. Fannie and Freddie did go under. They got taken into conservatorship. And so while there's some potential downside in spread, I think there's way less downside in agency mortgage spreads and, for example, corporate bonds that have a tighter spread on kind of the index and have credit risk. All right, so let's talk about macro before we dive deeper into the portfolio. And the most important thing, I guess, that's out there continues to be inflation. Here's a look at the three components of inflation. Core goods in the gray is what initially spiked, right? The supply chain issues, all the ships sitting off Long Beach Harbor. At one point, there was like 100 of them just lined up, waiting to come in. That is now coming down as that front-loaded demand for goods subsides. You can see this in PMI manufacturing printing below 50. The goods demand is weakening, right? People bought cars, people bought, a washer dryer. They only need one. They don't need one every year. And so that is expected to come down. What caught up and is now seems to be remaining sticky is shelter, which is in the blue, and then core services ex shelter, and services are driven by wages. And we have a supply-demand imbalance in the job market. And so that's what the Fed's conundrum is, and that's why they're saying they're not going to cut rates, unlike what the bond market's pricing in. So let's look at some slides on those things. We got a lot of housing exposure in the portfolio. We saw the exposure to RMBS. We saw the exposure to CMBS, of which there's some multifamily exposure, but housing, to the detriment of the inflation fight, remains resilient. It's about down 5% from the peak. The peak was the summer of last year as far as home prices. And the reason it's not collapsing like some of the haters that were calling for, down 30, 40% like the GFC is they don't look at the data. They just like to say, they think it's like a bond price, yields up, home prices down. It doesn't work like that. There's plenty of times going back through history where rates went higher, like through the 70s and 80s and 90s, when we had a rise in rates and we had home prices go up. It really comes down to supply demand. And here you can see that existing inventory is close to all-time lows. I have data going back prior to 1999, but trust me when I tell you that we're near all-time lows. All-time lows happened kind of during COVID. We got down to about 850,000 units of existing inventory relative to a continually growing population. And we've been underbuilding. And so this shows you housing starts in the blue versus household formation, right? People creating households. And we've been building less homes and household formation since the GFC, leading to a pretty large cumulative housing shortfall in the millions. Per this metric, we're 6 million underbuilt on housing. So lack of supply, millennials still needing to buy homes. That means prices don't go down that much. We're down again 5% nationally. Some regions that went up a lot, especially kind of the tech heavy regions, are down. Seattle, San Francisco, San Jose, San Diego, probably down low teens. Boise, not surprisingly, but demographics are holding up. Some of these regional areas in the Southeast, where you're seeing population migration to low tax states like Florida, right? even if we go into recession, we've got a ton of equity in homes. People do not walk away from equity. So they'll sell their house, they'll take their equity. This shows you the percentage of underwater mortgages that we had during the GFC in green or turquoise, and look how low it is. Like a lot of people just have a ton of equity in their house. Home prices are up a lot. And if they bought a house even today, you have to put money down. So that means you're not going to walk away from your house. So why do I show the slides? To A, make you feel good about mortgage credit allocations and mortgage credit performance, but B, if home prices don't go down, then likely rental rates don't go down that much either. And that's going to mean that shelter component of CPI, which tends to lag by about 12 to 18 months, probably isn't falling that quickly. So that could stay elevated, which again is not good for the Fed, which means they may be keeping their rates higher for longer. Doesn't mean they need to hike again, but at least keep rates here for a while, not cut immediately in September. And the other dilemma they have is the fact that wages remain strong. So here is average hourly wages in red, Atlanta Fed wage growth tracker in blue. Both seem to have peaked. They've come down. Hourly earnings down a decent amount off its highs, but it's still elevated. I mean, it's still 5%. So they're looking at this. They're looking at the job openings, which fell from its peak of around 11.5 million job openings to 9.5, but that's still elevated relative to the people looking for work. And so they're worried that this stays kind of elevated and they need more slack in the labor market before they can cut rates. The problem they have is that is backwards looking. Unemployment is the last thing to rise when you go into the recession. So what they need to do is look at some of the forward-looking metrics that we look at and see are kind of in recessionary territory. Here's LEI. We show this a lot. Probably see it from me, from Jeffrey Gunlock, from Jeffrey Sherman on our different webcasts. And it's been negative like 7, 8 months in a row. And it usually leads recessions. And usually by the time we're this deep negative in LEI, you're in the recession. So we do have some things that are positive. I will say, while manufacturing, as I suggested earlier, is printing below 50, 47.1 here, which is contractionary territory. Services PMI still slightly positive here, 51.9. Retail sales came in okay. And Home Depot said that consumer slowing down. But there's kind of this mixed bag economy that's going on out there, consumer being kind of resilient with maybe some pent-up savings, but they're starting to go through that, all right? The other metric, this is the Powell's metric that he likes, the Fed likes, the 10-year 3-month instead of the 10-year 2-year inversion. And this saw this big spike of this inversion right after SVB. This got all the way down to about 180 basis points at one point. It's now at 162 as of whatever date this was, which I don't see on my screen. No, May 15th. And again, usually when this flips this negative, almost every time I've seen a recession here. So again, these are kind of the recession watch things out there. Doesn't mean that we can't muddle along here and have another positive quarter of GDP thanks to the consumer. But just things we like to point out and say, hey, these are reasons we've been extending duration in some of our portfolios. Even in income, we're a little bit longer than we historically have been. One thing that's kind of doesn't always work for recessions, but I just wanted to point it out because I do think it's interesting about the behavior of the consumer is that we had all this pent-up savings thanks to the stimulus checks. We started spending, and dropping our savings rate. This is like a monthly savings rate as a percentage of disposable income, and it kind of was dropping. It was almost alarming. And you could say, okay, well, inflation's high, so people got to spend more money for food and at the tank and so on and so forth. And it's gone up very recently. So has it gone up because people are getting paid more, or is it going up because people are worried about the future? We've got a lot of negative consumer sentiment data, and people start saving when they're worried about maybe they need money for a rainy day. So that's just something to think about is what does this mean, this increased savings rate? While there are pent-up savings that the consumer has in the bank, I think I saw the latest number was 500 billion, down from over $1 trillion right after all the stimmy checks. They're spending through that, and so maybe once they spend a little bit more through that, they may want to start building it back up for that rainy day, and that means a slowdown in consumption. That can also be a catalyst for slowing growth. So just some things to think about, not like doom and gloom end of the world right now, but just that there are risks out there. There are signs that economy could be slowing. And so maybe one should be a little bit more conservative with their kind of asset allocation, especially equities that seem, more positively priced with, a pushback up in earnings expectations on the S&P 500 in the fourth quarter. Whereas I think fixed income, at least parts of fixed income, seem to be pricing in a little bit more risk with spreads being wider. Now, the banking issue is something new from the last time we had an income webcast. The last time we had one was about 6 months ago. And when SVB happened, I turned more negative because I thought, why would anyone ever leave their money in a regional bank and not just buy T-bills and money markets and just hang out and enjoy higher yields and the almost nothing they pay you in the checking account or savings account? And we saw that spike. It's kind of going sideways. I think just money is a little lazy. If you're under the 250K FDIC balance, maybe you're not so worried. But I think the longer that this banking issues get stretched out, the longer the curve is inverted, the more banks that potentially go under, the more to the forefront that, this type of, reality comes out to mom and pop that, hey, look, maybe I should just be in the big money center banks and maybe I should put some more money in money markets and things like that. This is a strain on bank deposits. And I think they've already pulled back and they'll pull back even more. They're big lenders to small business. Small business is 46% of employment in the US. And so I think that was the catalyst for me that, hey, maybe that's going to push us over the edge into a recession towards the end of the year. Now, so far, the money hasn't come out as fast as I expected. It's kind of slowed down a lot, but maybe it picks up. So I like to watch this data. We'll keep our eyes on it. But I think on the margin, I've had some anecdotal conversations with some small regional banks, and they all say not only have they been pulling back, but borrowers aren't looking for the money. Maybe that's just because rates are so high. I mean, if you're borrowing as a small business at like prime plus 500 or something, you're talking about double-digit cost of funds. So do I really want to borrow at that rate? Maybe I'll just hold off opening another store or restaurant or hiring some more people and kind of wait for more clarity, wait for the Fed to cut, wait for the economic certainty to, become better, that this is going to be not a hard landing, but a soft landing. So I think watch this data. We'll keep you posted on any changes we see. If not on the next income webcast, you can check into the next channel 11. All right. So that's, I just want to save some time for Morris. So I'm going to pass along to Morris.
All right. Thanks, Ken. Hello, everyone. So, we'll start with commercial real estate first. With respect to what we're seeing on the boots on the ground in terms of commercial real estate, again, there's a tighter lending environment that's ongoing at this juncture. I would just point out, market's somewhat self-regulating. This is an environment where lending was loose coming into this rate hiking cycle. I think the environment in itself is the stresses that's causing the commercial real estate right now is higher interest rates. It's less about deterioration in terms of credit quality or looser lending. But in essence, self-regulation, you're seeing this from a loan-to-value perspective in terms of leverage ratios. It dropped precipitously as the Fed continued to hike rates. Even into 2022, I would say that loan-to-values were low. And as we're kind of thinking out on the horizon, we're looking at commercial bond spreads. Here, you can definitely see the recent changes in terms of spread widening across the capital structure. A lot of this due to a combination of negative headlines surrounding commercial real estate in conjunction with the uncertainty that investors are looking out on their horizon for commercial real estate properties. And then you layer in what happened in March, the regional bank dilemma, and that's puts together a concoction of reasons that CMBS spreads decide to widen. I would say that as we were kind of looking at CMBS market, it definitely looks interesting. I mean, just even looking back on a 10-year horizon, similar to the analysis that we looked at across the structured products sectors, CMBS does screen cheap, even on a percentile basis in terms of spreads. Now, going into relative value versus corporates, again, AAAs versus investment grade corporate, AAA CMBS versus investment grade corporates. On the left-hand side, you can see the blue line screening cheaper relative to corporates, and then even more pronounced where BBBs relative to high yield. I would point out it's not without risk. Clearly, the market is trying to price in some risk as associated with potential headwinds that commercial real estate market will potentially face. A lot of this has to do with office as well, in terms of office exposure, underlying transactions. But like I tell investors, keep in mind, these are debt instruments. These are debt investments. You are in the mortgage and the bonds collateralizing these that are made up of multiple different mortgages, underlying commercial mortgages that are diversified in nature. I think risk is largely going to be idiosyncratic at this juncture. But with that said, some deals may trade wide because it may have a concentrated exposure to certain offices and vice versa. Looking at price changes, again, we saw spreads movement, so clearly prices also changed as well. We're we have been heading in the direction of near the March of 2020 lows. I think across the capital structure, in essence, this repricing is somewhat reticent of what was experienced during March of 2020, which for the reasons during 2020 was more of a liquidity situation, as opposed to currently we're trying to price in fundamental deterioration. A lot of the repricing has to do with within CMBS has to do with extension. So investors are trying to rationalize when the timing of payback would be for particular loans that are underlying these pools. I would say generically there has been market dynamics where investors are just blanketly and extending loans for the sake of extending, but not really paying attention to what exactly are the underlying pool look like, and that dynamic in itself presents opportunities. We have seen consumer loan delinquencies trending higher since the lows in terms of June of 2021, particularly in the lower credit score area where the FICO scores are lower. And I think from a trend perspective in itself, while delinquencies have been trending up, I'd say that generally speaking, consumer loans in terms of where we are in terms of these delinquencies compare versus previous cycles, we're still at very, very low levels or below those levels. Thinking about the consumer loan sector, just given the delinquency in terms of fundamentals, here now we're seeing yields of these securities. On the left-hand side of this chart, you're seeing single A yields currently at 7.57% relative to where yields were in December of 2021, where you're about almost sixfold in terms of yield pickup relative to the 2021 environment. The caveat would be, yes, rates were extremely low in 2021, but I would kind of point out also spreads have widened in a meaningful manner, even in the ABS consumer loan side. And for BBB, same picture. And as we're kind of looking out into the fundamental world, there is a relative value component. You're getting these excess yields, you're getting exposure to consumer loans, but I would point out, just given the credit enhancement that we're currently seeing within these bonds, a lot of these bonds are pretty short. So even for a BBB tranche, that's fairly short. Given the delevering nature of these profiles, you're seeing credit enhancement or subordination continue to build as consumer loans pay off. So here on the right-hand side, you're seeing CE build from the date of issuance relative to the seasoning of the transaction. At the very bottom portion of the chart in the green, those are cumulative net loss that's experienced. It peaks out around 10%, but as you can see, for single A, even for BBB bonds, over time, you have significant amount of protection. And we think at these yields, a lot of these investments make a lot of sense. On a relative value basis, similar to the CMBS picture, you're seeing senior ABS screen cheap relative to corporates. Similarly, for other areas of below AAA, so AA to BBB asset-backed securities. They're also compare on a relative value basis, screen cheaper versus corporate BBB as well. So there is a thematic tone as we're looking within structured credit, whether it's CMBS or ABS, and including RMBS, you're definitely getting that relative value pickup. Looking into the corporate world as we're thinking about CLO, we would point out that just relative to default rates have been low. There has been we do have an internal view that defaults will continue to likely pick up starting at the lower rated companies or riskier companies. But I think in essence, if you just think about the CLOs market relative to what we experienced during the GFC, so here is a good comparison. During the GFC, CLO 1.0 transactions, so transactions issued prior to 2009 and prior, AAAs experienced 0 defaults. Similarly, AAs only experienced about 1 default out of 616 transactions. And you can kind of get the thematic tone here where even during the GFC, CLOs were adequately protected, at least the performance of the underlying transaction, alignment of incentive in terms of the manager that's managing those deals helps, in conjunction with the diversification of underlying pool, helps alleviate stresses underlying those bonds. And now looking to the right-hand side where you're looking at deals issued 2010 and later, again, defaults have been extremely low, not too surprising, just given corporate defaults have also been low. But we're pointing this out that the CLO market, there's a reason why it's popular. As a function of that, the yields have also gapped out. Similarly to other structured credit, where even on a yield basis, you're seeing it near its sort of 10-year highs within the corporate CLO market. So net, whether it's CMBS, ABS, and or corporate CLOs within the securitized product cohort, you're definitely seeing this same thematic tone where spreads have widened and yields are high relative to corporates. Through the current cycle of the CMBS market, spread widening is largely because investors are trying to price to worst, and that creates opportunities, and that's one of the reasons why we're constructive within the CMBS market, despite the headlines that we're seeing and despite some of the headwinds, because a lot of these deals are structured appropriately. There's been a lot of good collateral underlying these transactions, and we have seen loans pay off in a timely manner. So that concludes the extent of the current webcast, and I appreciate everyone's attention, and we'll continue on later this year. But thank you for the support, and wish everyone good luck.